Okay, welcome once again to 5 Homes to Freedom. We're going to continue on in Module 2, Lesson number 4. And in Lesson number 4, we're going to be looking at down payments. All right. So what we're going to be looking at with respect to the down payments is how much you actually need for a down payment and where can the money come from. And I'm not suggesting, although it would be very nice, that you print your money off at home on your printer because that would be forgery and that's just not allowed. So first of all, how much do we actually need? So when we're taking a look at conventional lenders, so I'm talking about the big banks, the main banks that most people use, or the mainstream lenders, these individuals, these institutions, they have to follow very strict guidelines that are set out by the government, the federal government. And currently, they have been mandated to require that the investor put 20% down for all investment properties. And I'm talking residential investment properties, so units 4 or less. Now, there's going to be times where the lender may say, we want you to put 25% down or even 30% down. And that could be dictated by your own credit worthiness. It could be dictated by the lending environment at the time. Back in 2007, 2008, when we had that major meltdown in the financial industry, there were many banks that were not lending any money, even at 20%. With 20% down, they wouldn't lend any money unless it was insured. And as a result, that made it very difficult for a lot of people to be borrowing money at the time. So rules can change. It's a very fluid environment. But currently right now with the big banks, you're looking at 20% down. Now when you start to look at the non-conventional lenders, so you're talking about people that are not in the mainstream, they're people you didn't even realize were out there lending money. So these are what you call your B lenders. There's also your mortgage investment corporations. And again, those are groups of individuals who gather their funds together and create a company to lend out money. Then you've got your retirement savings, and then obviously using other people's money. So when you're dealing with the non-conventional, it's not necessarily the same set of rules that they follow. Therefore, you could get away with a little bit higher loan to value. You might get 90%, but most people lending money out are not going to lend 100%. They're going to want you to have some skin in the game. And they're going to be very similar to the banks. They're going to assess the risk, what they deem you to be high risk or low risk, and if they deem you to be a high risk, they may only lend you 70% of the value as opposed to 80%. So they are able to operate on a much broader spectrum because they don't have to follow the same rules as the big banks. Then, so I think for our situation here with the 5 Homes to Freedom, 99.9% of the time you're going to be looking at an 80% loan to value. So we'll assume that all the deals moving forward are going to be 80% financed by the lender, 20% by you and or your investor through some way, shape, or form. So now we'll take a look at the sources of the down payment, and this is one that sort of ties in with mortgage fraud and wanting to make sure that you follow the rules correctly. So there's your own personal cash, but of course you have to provide proof. And then there's lines of credit, whether it's secured or non-secured lines of credit, and then using other people's money. So we'll look at each of these in a little bit more detail here. When you're talking about your own personal cash, we're talking about money from your own personal savings account, or it could be from other funds that you have. You might have some GICs or guaranteed savings someplace, or you may even be cashing in some of your retirement savings funds in order to come up with the cash for the down payment. Regardless of where it comes from, the lenders are going to ask for proof of where it came from. And it's not for their own personal satisfaction, it's for the government satisfaction. They need to make sure that the money is legitimate and it's not being laundered for any illegal activities. So if you're using your own savings account, they want to make sure that that money's been in your savings account for a minimum of 60 days. So you're going to have to show them your bank accounts. If you've just moved the money into your bank account from another account, then you're going to have to show them the account that it moved from. You have to basically provide the paper trail so they see where the money came from. A lot of people, like to use cash. It's becoming less and less frequent, but it's becoming more and more difficult to actually do. And this is definitely not acceptable. Even as a realtor, for us to accept cash as a down payment, like a $5,000 down payment, we're not allowed to refuse it, but we're highly discouraged to accept it because we then have to fill out all kinds of paperwork asking where that money came from, because it's another easy way for illegal activity to be laundering their money through that. Then when you have the lines of credit, now a line of credit, a lot of people treat a line of credit very similar to a mortgage. And the reality is it's not anything like a mortgage. A line of credit is just an amount of money that the bank or lending institution is willing to lend you. And it's a demand loan. What a demand loan is that if for whatever reason the bank decides that they want to call that money in, they'll give you, depends on the details, but they could give you 30 days notice and say we want all our money back. Now, if you've got a $30,000 line of credit and you've maxed it out, you're using it in investments, or you've bought doodads with it, whatever the case may be, then all of a sudden the bank wants that money back. Where are you going to get that money? So it's very unlikely that the bank will do this. I have seen it happen occasionally, and it's usually when the bank is a little bit concerned about the individual and they want to reduce their risk. I've seen it happen outside of North America as well, in some of the third world countries where the banks will refuse to renew mortgages and whatnot. So you've got to and they'll just call the loan in. So you just need to be aware that this is a demand loan, and it can either be personally unsecured or secured. When it's unsecured, that means that it's not tied to anything of any value. It's based upon your credit worthiness, your promise to pay it back. Therefore, it's going to be deemed to be slightly higher risk. And because it's at a slightly higher risk, it's going to have a higher interest rate as well. The other thing with lines of credit is they're not fixed rates. Like a mortgage can be a fixed rate for a long number of years. With your lines of credit, they can change the interest rates with 30 days notice. Also, because it's directly tied to your own personal credit worthiness and it's not secured by a tangible asset, they won't lend you a large amount as well. So your unsecured amounts typically are going to be considerably lower. Obviously, the better your credit score, the better your credit rating, the higher the amount they will lend you. But it's typically going to be a lower amount. Then we look at the personal secured lines of credit. And what this means is that the line of credit is secured usually against an asset like a house or another property that you may be investing in as well. You're going to get slightly higher rates than a conventional mortgage, but your rates are going to be considerably lower than your unsecured line of credit. So in today's lending environment, for example, you can get a decent mortgage for a rate of about 2.5%. A personal secured line of credit depends on your credit worthiness and the asset that's being secured against. You can probably get it for 3.5, maybe 4%. If you're going for an unsecured line of credit, then you're likely to be paying 8 to 10% interest. So you can see how the interest rate is different for the different types of loans. Because it's secured against an asset, the lender deems it to be lower risk, therefore they can afford to charge lower interest rates. And because it is going to be secured against an asset, they'll still only go to a maximum of 80% loan to value. And again, that has changed because back in the early 2000s, they were allowing, for a brief period of time there, they were allowing you to finance up to 100, and in some cases 105, 110% of the asset value, because they were literally counting on the value of that property increasing at an appreciation of 5 to 10% each year. So they figured it would be a low risk. All right, and then when you take a look at using other people's money, we're going to be looking at family, friends, co-workers, different types of investors or joint venture partners, and then the seller themselves. And it's similar sources. It can be their own personal cash, it can be lines of credit, it can be people's retirement funds, or a straight out loan. So let's take a look at family first. One of the nice things about using family is that they can lend money, and they can call it gifting. It's a forgivable gift. So this is typical when you're buying your first home and it's your primary residence. Quite often a parent will give 5 or 10% of the value of the purchase price as a gift, and the bank will accept that as a forgivable loan. Therefore, it's not going to count against you. Whoever's doing the gifting, whether it be a parent or brother, sibling, whatever, they're still going to want proof of where that cash came from. So they want to make sure that it's been sitting in somebody's account for 60 days, or it's that old paper trail. And then, of course, there's the personal loans. They can just lend you the cash, just like a bank would, with whatever terms that you both agree on. The family member could be lending you their lines of credit. So your family member could borrow from the bank on a secured or unsecured line of credit, turn around and lend you that money. And then they could also just have a mortgage against the property or mortgage their own property as well. So there's a variety of different ways for other people to get access to money. Retirement savings is another big one. The problem is that when it's with your family, it's going to be arm's length. And one of the rules with using retired savings is that at arm's length, it can only be placed in a first mortgage. And being in first means you can only go up to 80%. So it still means you're short 20%. So it sort of defeats the purpose of leveraging other people's money. Plus, depending on the lender, you may also have to, or most likely will have to, insure that first mortgage as well. So it's just not as useful for you to use your family's retirement savings for investing purposes. Now, when you look outside of the family, though, and you start to look towards your friends and co-workers, gifting does not work. The gifting will only work if it's from family members. Then your friends and co-workers can they can use their own cash, they can use their own lines of credits, they can create mortgages, just like we talked about earlier. But here, this is a big one. This is where they can actually start to leverage their own retirement savings plans, because they're now at non-arm's length. So they're not related to you. So these mortgages can be created in first, second, or third position, and it's most popular to put them in second or third position. The maximum loan to value is 90%. However, there are ways of leveraging it up to 100%. What I suggest you do is you do this after the fact, though. And what I mean by after the fact is you use your own cash to buy the property. So you get the conventional mortgage from the bank, the lender, at 80% loan to value. You put the 20% down. A month after you own that property, you go to your coworker, friend, whoever, who is willing to lend you the 20% difference through a registered retirement fund mortgage. And if the value is, they'll only allow you to go up to 90% of the purchase price or the value of the property. So if you're able to negotiate a really good deal, and you bought the property for $350,000 and it was a $400,000 list price, that $50,000 equity that you just gained is going to help you, because you can then go to your friend and say, I've got a property that's worth $400,000 and I would like to do 90% of the $400,000. So that's going to give you a $360,000 mortgage, which is more than what you actually paid for the property. Your friend or coworker is still happy because they're at 90% of the market value, so they feel there's still some equity in there to protect them. You're happy because you got all your money, and in some cases a little bit more out of the deal, so you can go out now and recycle that money and buy another property. So that's why you want to do this after the fact. So then when you talk about using investors who are in a non-equity position, you can use their personal cash or their lines of credit mortgage, very similar to what we talked about with the non-family members. You can also use their retirement savings as well. So there's really not a whole lot different between using an investor who is a non-equity position. Where it does become a little bit more interesting is when the investor wants an equity position. So they may be a silent partner, but they're going to give you all the cash you need. But now where that cash comes from is very important, because they can still use their cash, they can still use their lines of credit, they can use borrowed funds against other properties that they may own, but they are no longer able to use their registered retirement savings because they are now they are arm's length. So it's no longer applicable. Okay, so it depends where the money's coming from will help dictate what type of investor relationship you're going to have as well. One thing I do want to talk about before I move on is lines of credit. A lot of people don't realize that they can use their lines of credit, their own personal lines of credit, for the down payment. Because if you have a $50,000 line of credit and you haven't used it, there's nothing owing against it. It doesn't matter whether you have it free and clear or whether it's maxed out at $50,000. When the bank or the lender looks at you to qualify you for the mortgage, they're going to assume that that line of credit is maxed out. So if you have the ability to borrow $50,000, they're going to assume you've borrowed $50,000, and they're going to calculate your credit worthiness based upon that fact. So if they're going to do that, that means you can actually use that money to create the down payment for the property. It's the same thing when your lender is coming in an equity position. If they're going to use their lines of credit, then when they qualify for the mortgage, they have to realize or recognize that that line of credit can count against them as well. So this is why you want to sit down with a good mortgage broker and ask those types of questions and make sure you understand them as well. All right, so now we're going to take a look at using the seller's money. And when I'm talking about using the seller's money, I'm talking about a VTB, a vendor take back. And this could be in a first position. It could also be in a second or third position. It really depends on the scenario. Now, most lenders who are in first position will only allow small VTBs to come behind them in second or third. And the lender will probably make a statement that they don't want total financing to exceed 90%. So that can create a little bit of a challenge for you. Typically they only want to do 80%. Sometimes they'll do 90%. But it's still 90% is better than having to come up with the whole 20% yourself. Now what I like to do is whenever I'm dealing with in negotiations or dealing with an investor, I always try and put myself in their shoes to look at whatever the opportunity is from their perspective. Now, unfortunately, I don't think a lot of people do that. Most people will look at it from their perspective and their perspective only, trying to make it a win for them. When you start to look at things from other people's perspective, even the bank's perspective, when you look at why the bank is giving you such a hard time lending money to you, put yourself in their position, and if you were the bank, ask yourself this simple question. What would you ask for in order to feel comfortable if you were handing out all this money? So, are you going to want to see their credit history? Why not? And if you're going to be asking for a vendor take back from somebody and they want to see your credit history, don't be offended. They just want to protect their money. Should you ask for an appraisal? Absolutely. What interest rate would you want? Well, if it's your money, I expect you're going to want a higher interest rate now. But if you're borrowing the money, you're going to want a lower interest rate. And if you were lending them money, would you be comfortable lending them 100% of the purchase price of that property? Or would you like them to have a little bit of skin in the game? And if you want them to have some skin in the game, why is that? Well, it's the same logic that the banks and the other lenders are going to be using as well. So it's not unrealistic. The bottom line is that buyers with nothing invested in the opportunity are going to be more likely to default. They're not going to care as much for the property. They're higher risk for them to walk away from it. With respect to the money laundering, I mean, this is a huge issue, unfortunately, right now with all the criminal activity. It has been an issue for a long time, but now with all of the terrorism around the world and money being funneled outside of the countries to all these fundamentalists and whatnot, it's becoming more and more of a serious issue. So they're really trying to clamp down on it. And unfortunately, real estate is one of the easiest places to launder money, which is why they are making the rules much more difficult. Then you also have mortgage fraud. And mortgage fraud, it's not too bad right now, but there's something called the Oklahoma. And this is a scheme from back in the 60s and 70s where, and guess where it originated? Down in Oklahoma area. But this goes on all over the country. And what they're basically doing is they're telling the bank that the property is going to be worth $400,000 and they're going to borrow 80% of that $400,000, yet in reality the property is only worth $300,000. So they'll create a false purchase and sale agreement for the $400,000 and use that to get the financing. Now there's been all kinds of safety measures put into place in order to avoid this happening in the future, and this is why the banks send out appraisers now. So the bank will send out an appraiser to verify that that property really is worth $400,000. If it's not, it comes back at a $300,000 evaluation. The bank will say, all right, well, we'll lend you 80% of $300,000, but not the $400,000. Unfortunately, though, where there's a will, there's a way, and in the past there's been collaboration between investors and appraisers, and in some cases even lenders and mortgage brokers, where they will collude together to create these mortgage fraud deals. So it seems like every other year or so you always hear of a Ponzi scheme or a mortgage fraud scheme of this nature. And unfortunately, these individuals who are doing the fraudulent deals are making it more difficult for the legitimate investors because the banks are being forced to implement more and more rules, making it more difficult for us to invest. So that's a little bit about the down payments, where the money can come from, and why the rules are the way they are. So once again, save your questions for our live recorded webinar coming up at the end of this module. And in the meantime, if you have any questions, feel free to email me at ken@fivehomestofreedom.com. Until our next lesson, we'll see you at the top.